Hey guys, it is Julie here with TipRanks. In today's video, we're going to be comparing the website traffic growth for two giants in the streaming industry. So let's get into it. Alright guys, welcome back and thank you all so much for being here. Today we're taking a look at two massive companies in the streaming industry and trends in their recent website traffic growth and how this will prepare us for their upcoming earnings reports. Now, the TipRanks website traffic tool gives you insight into unique and total visitors to a company's variety of domains. This can help us prepare for their earnings as to whether we can expect an increase in trends or prepare for a surprise downturn. And this is unique data that is normally not available till after their reports. Of course, this is just one piece of data compared to the many that all comes out during their earnings, but can help give us a unique perspective. So, heading over to the TipRanks website, under Research Tools, we're headed to Top Online Growth Stocks, where I'll find a list of top trending websites. Under the categories here, we're going to narrow it down to those streaming services, and I'm going to search by market cap so we can get those big names right up at the top. At the top of the list, we have the Walt Disney Company here, and you can see they have a handful of domains that we're able to track the website traffic on, including Disney+, Hulu.com, and ESPN. Of course, Walt Disney is a company known around the world. Not only are they known for their entertainment resorts found in all corners of the globe, they're also famous for their entertainment section with their Walt Disney Studios, Pixar, and Marvel. But in the last few years, they've been moving more and more into the streaming industry with companies such as Hulu and Disney+. With a market cap of over $184 billion, their stock trades under the ticker DIS, currently priced just above $101 per share. Now, the stock is down 22% over this past year, but has been starting to climb back so far year to date. So let's take a closer look at those website traffic growth trends. Going back to our list here, we can see that Disney has an estimated 645 million visitors per month, and we've seen a lot of positive monthly changes for their streaming companies, including 47% growth on ESPN. And heading over to the Walt Disney stock page, we can see further details under the website traffic chart. On the website traffic chart, just looking at Disney+, we can compare the website traffic from last year and see a big increase. From the same quarter last year, total unique visitors are up 32%, but from the previous quarter, they are down slightly. We can add in other sites, such as Hulu, to compare as well. Walt Disney shook things up back in November when they brought back Bob Iger as their CEO after a brief period away. Now, all eyes will be on their earnings report coming up in 28 days, as this will be his second quarter back at the helm. Disney will be reporting on May 9th, where analysts are expecting earnings per share of 97 cents. Now, this is a decline from last year, but if we look at their most recent reports, they did exceed it in the previous quarter. It seems that hedge funds are feeling more bullish with Iger back in control as well, as we've seen a sizable increase in those holdings. In the last quarter, hedge funds increased their holding by 8.2 million shares, and down below we can see a number of high-rated firms increasing or taking new positions in quite sizable amounts, including Trion Fund Management, who holds over $784 million in the company. So, how do the Wall Street analysts weigh in? Well, they also seem to have a bullish outlook with an overall strong buy rating on the Disney stock. That is based on 20 overall ratings with 17 buys and 3 holds. Their average price target comes in at $128, which would be an upside of about 27% from current prices. The most recent rating just came in yesterday with an upside of 28%, and we have a lot of analysts rating around that price point. So we will see if overall website traffic growth will help Disney come out with a positive earnings report. Now, the second streaming company that we're looking at today is none other than Netflix. Netflix trades under the ticker NFLX with a market cap of $151 billion. Now, they did drop off hard back in the start of 2022, but have been climbing back ever since and are up 54% in the last 6 months. Netflix, of course, is the OG of the streaming industry. Starting off back in 1997 with mail-ordered DVDs, they now have over 220 million customers globally across 78 different countries. Now, while they are one of the largest streaming platforms, the company has faced headwinds in the last couple of years as they've lost some market share to other competitors in the streaming space. And most recently, they shook things up when they started to implement rules against password sharing. So how has this reflected in their website traffic? Well, Netflix has seen a steady increase in the estimated website traffic over this past year as they've been adding more and more popular titles. If we compare that traffic from last year, we can see in the unreported period that we do have an increase. From the same quarter last year, total visitors are up about 18%, and from the previous quarter, over 9%. Their next earnings report is coming up soon on April 17th. The focus of this earnings report will be how that crackdown on passwords and their new ad-supported service have impacted things. Analysts will be expecting earnings per share of $2.89, which is a bit of a decrease from last year's. Now, of course, in their last earnings report, they had a wide miss on that earnings, but did come in ahead of expectations on subscriber numbers, which are closely watched for them. Ahead of this upcoming earnings report, analysts have been weighing in with their expectations. One of those being an analyst from Jefferies. Now, they did lower their price target to $415, which is still up from current prices. But they said commentary on the password crackdown and rollout of advertising video on demand is more important to the investment thesis than the actual results. And taking a look at the overall analyst ratings, we definitely have some more divided opinions, as the Netflix stock does come in as a moderate buy. That is based on 35 different analyst ratings, split nearly in half between buys and holds with a couple of sells. The average price target is $357, but we do have a wide range from a low of $230 all the way up to $440. And a big range of price targets coming in just this last week, from a downside of 26% with this hold rating to an upside of over 22%. So we will see if that website growth is enough to push the Netflix stock in that positive direction. That is our quick overview of two streaming giants and their website traffic. Let me know your thoughts in the comments down below if you think these companies will come out with some positive results in their upcoming earnings. You guys know I always appreciate hearing from you. Please keep in mind these videos are never a suggestion to buy or sell any specific stock and are just meant for information and entertainment purposes. Please make sure you're always doing your own research and due diligence before making any investment decision. If you made it to the end of today's video, don't forget to hit that thumbs up button and make sure you're subscribed to the channel as well. Thanks so much for watching. Have a great day, and I'll see you back here next time.